Hey guys, Dave Keller here with Market Misbehavior. I'm asked a lot recently about the 200-day moving average because the S&P 500 has rallied right up to its 200-day where it failed a number of times over the last 12 months. So today it's all about the S&P 500 and its 200-day moving average. So we talk a lot about the 200-day moving average in technical analysis because it's one of the more widely followed technical indicators. Besides just price and volume, sort of the normal fundamental building blocks of technical analysis, a moving average is a simple way of basically eliminating the noise or smoothing out the price data by looking at average prices over a period of time. We call it a moving average because there's a moving window, 50 days, 200 days, or whatever, and that little window moves along through the course of time. It can be a really interesting way of measuring trend, and today I'm going to share with you a couple different things, a couple different thoughts as the S&P is testing its 200-day moving average. Before we get to the charts, if you like this thinking about investor decision-making, behavioral finance, and technical analysis, I hope you'll subscribe to my channel. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you think the S&P is more likely to go up 10% from here or down 10% from here? Let me know in the comments below and why. Now let's look at the charts here, and you can see a daily chart of the S&P 500 going back the last 2 years. And I started with a 2-year time period so you can really focus on the rotation from a bullish phase in 2021 to a bearish phase in 2022. Now, how can we describe or I guess illustrate best the fact that we're in a bullish phase or a bearish phase? Well, it comes down to some basic measures of trend. Charles Dow in the early 1900s talked about an uptrend being a pattern of higher highs and higher lows. So as long as the high prices, if you think of the peaks and valleys in the price, as long as the highs keep getting higher and the lows keep getting higher, we're in an uptrend. When that stops happening, when you start making lower highs and lower lows, the trend is now down. So clearly that happened between 2021 and 2022. We had very much a reversal. We can also smooth the price data out with moving averages. In blue, we have the 50-day moving average. In red, we have the 200-day moving average. And what you'll notice is a couple different things, right? You can see a couple things, right? We can see in an uptrend how the price often pulls back to the 50-day moving average and then reverts higher. That was a big story in 2021. We consistently pulled back to an ascending 50-day moving average, and the price went higher. When does the price break down through the 50-day or the 200-day moving average? That can be an important signal. When does the 50-day cross down through the 200-day, what's called the death cross? Or do we get the opposite of that, where the 50-day crosses up through the 200-day? We call that a golden cross. Now, while those don't necessarily test as the most effective trend-following devices in the world, they tend to be widely followed and widely reported because they almost jump off the screen. It's so clear when that happens. So now that we've defined some of the different ways we can measure the trend, why is it so important that the S&P is testing its 200-day moving average? Well, for me, it all comes back to what has happened in the market, right? What has happened when the S&P has tested its 200-day from below? Well, after the initial sell-off in the first quarter of 2022, we had a number of rallies that actually got back above the 200-day moving average. And if you can remember back to almost a year ago, the first quarter of 2022 was still very much an open question, right? We'd made a couple lows, but we were trading back higher. And the question is, do we make a new swing high? Do we get back to 4,800 on the way to 5,000 plus? That was very much a real question here as we broke to a new swing high, and we were back above moving average resistance in late March. From April, though, you can see we reverted back lower. We kept making new lows, and then the 200-day moving average became more and more significant. While the 50-day moving average was an important barometer in 2021, 2022 was mostly about testing the 200-day moving average from below. We saw that in August, and while everything seemed super encouraging, stocks making new swing highs, the S&P getting above its May high, all of a sudden the 50-day moving average sloping higher, we literally stalled out almost to the tick right at the 200-day moving average. Subsequent bear market rallies in October, November stalled out at the 200-day moving average. So the question right now is this time different? Do we have enough of a momentum to push us above there? Now, what may be different is the fact that we've made a higher low, right? Before these other bear market rallies, we just come off a new 52-week low. So the fact that we actually made a higher low in December all of a sudden makes this a bit of a different observation than what we saw in the fourth quarter and in the third quarter of last year. So that's one thing to pay attention to. But the question remains, do we get above the 200-day moving average? Now, we have gotten above there, but it's important to note we got above the 200-day in November and in early December. What we did not get is what I call follow-through, which means actual following through, right? Exactly kind of how it sounds. Once you break a level, and this is kind of a basic concept of technical analysis, once you violate a level like a resistance level, a lot of times you just have that whipsaw, right? You have that one move and then we rotate lower. Look at the chart in November and December, you can see what I mean, right? You break through a level, but then you never follow through. And it's like all the momentum was just enough to get us to that point, but not enough to keep us going. We kind of came back down. The question in any sort of breakout, and certainly what we're seeing now, is there enough momentum not just to get us to resistance, but to get us through resistance and to power through to the upside? I would argue we've not seen enough of that yet, as the S&P once again has closed above 4,000 just this week. We've not seen enough to indicate follow through above the 200-day moving average, but I think that's an open question. Let's look at a little more data. Now what I'm doing is looking at the last 20 years. I'm still looking at daily data. The raw data is there in gray, and I've made it kind of lighter, and I've made the moving averages bold-faced. Same moving averages, so the 50-day moving average is in blue, the 200-day moving average is in red. One of the things you can do is what's called a crossover technique, which is you take two moving averages, a short-term and a long-term, and you see when they cross up and down through one another. That's a common technique in technical analysis, and some indicators like the MACD and others are literally designed on a moving average crossover technique, just using other things like an exponential moving average or something like that. But if you look at when the 50-day in blue crosses down through the 200-day, you'll see it happened here at the end of 2007, which is a pretty good time to be out of the market or short. You can see it turned back bullish the second quarter of 2009, not at the low. And again, this is not meant to pinpoint. You see, we didn't get a sell at the high. You get a sell signal after the market's actually rotated lower. Same thing, it's more of a trend following technique, not a trend anticipating technique, right? So the low happened in March of 09. You can see a couple months later, the 50-day crossed up through the 200-day. Now you can see a couple of whipsaw signals here in 2010 and 2011 where it basically short-term traded below, but again kept resolving higher. Told us to be out of the market in 2015, back in the second quarter of 2016. You can see again a couple whipsaws or a couple sell signals along the way in 2018 and in 2020. In most of 2021, actually all of 2021, in a bullish configuration. You can see you had what's called a death cross at the end of the first quarter of 2022, and we're very, very close to generating another buy signal, which would indicate that the uptrend is now higher. So just looking at a simple crossover technique, you can get a sense, while it's not perfect, and certainly there are times when the market's rallying and it's telling you to be out of the market or short, overall, the benefit of that sort of technique is that you are in for the long haul, right? When you have these long extended bull markets, like in 2013, 14, in 2017, in 2021, it very much tells you to be long and strong in the market. Don't question it, right? It only really signals if there's been enough of a price deterioration that you probably want to be cautious no matter what. Now, instead of looking at a crossover technique or just looking at where the price is relative to the moving average, which is what we talked about in that first chart, I would bring another idea, which is looking at the slope of the moving average. Now, hat tip to Willie Delwich, my friend at All Star Charts. I had him on my show on StockCharts TV earlier this week, and we talked about the slope of the moving average as being an important data point. So instead of thinking of multiple moving averages and where they're going and when they're crossing or how the price is crossing, just look at the slope. Is the moving average sloping higher or lower? And you'll find, again, if you follow along with my mouse, you can see we sort of turned negative there at the beginning of 2008. It's sloping downwards. All of a sudden, it turns higher there in June, July. That's sort of confirming we're now in an uptrend. It actually remains positive through 2010, turns negative there for 2011, back positive, 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 positive. Negative for about 6 to 8 months there in 2015-16, back positive. Again, just brief sell signals along the way there, but overall, the slope of the moving averages has been positive. You can see in the second quarter of 2022, it actually went from an upslope to a downslope and still trending downward. So even though the S&P is testing its 200-day, if you think of that methodology and the slope of the moving average, it's actually still sloping downwards until we see that confirmation where the slope of the 200 days is turning up. maybe there's not enough information yet to confirm more of a bullish trend. One final chart to just continue this or complete this discussion of moving averages and hopefully, again, to spur your own thinking about how to look at the trends using these different measurements. One of the things I like to do is look back at historical signals and see what sort of patterns emerge, right? What happened during a major market top or a major market bottom, and how did these indicators fare? I'm highlighting 3 periods from April 22 to the toward the end of 23. I'm comparing that. The section in green is mid 2015 to early 2016, and then here the end of 2007 to mid 2008. Now look at what happened in the red segment here on the far left. The market went from making higher highs to lower highs, higher lows to lower lows. We broke below the 50 and 200 day. Sorry, the 200-day moving average is actually the 40-week moving average in red. The green line is actually the 150-week moving average. This is a weekly chart of the S&P. So we went below both of those moving averages. You can see the 40 crossed down through the 150 here in late 08. You can see we broke down through the 200-day or the 40-week moving average, tested it from below, and then rotated lower. You can see that the MACD or the PPO indicator gave a buy signal and a subsequent sell signal, never really gave another buy signal and went lower. The RSI had what's called a bullish divergence, higher highs in momentum with lower lows in price, higher lows in momentum. But it didn't complete. It actually continued lower, and that was telling you that the trend was down. Now, everything I just said, except for the final part, is the exact same in mid-2015 to 2016. We were above the 40-week moving average and went below it. We actually traded below the 150-week moving average. The PPO gave a buy signal and a sell signal, and then gave another buy signal, which is different. We had a bullish divergence, but instead of resolving downwards, it resolved upwards. So up until that end, when we had the breakout back above the 40-week, when we had the failure to get above the 40-week, you can see that from there on, it was very different. 2008, of course, descending aggressively into the 09 low. 2016, continuing higher and making a new swing high. This gets us to where we're at right now. I would argue that which does this look like more, 2008 or 2016? It looks more like the latter. It looks more like 2016 in that we're really close to getting back above the 200-day or the 40-week moving average. That never happened here in 2008, which was one of the many signals confirming that the trend was lower. The PPO never gave another buy signal. We did get a buy signal in 2016, and we've already gotten a buy signal here. The differences also would say that the RSI, after having the bullish divergence, did not get above 50. It did get above 50 in 2016, and it's back above 50 here currently. So what we're seeing when you compare this to these historical 2 periods, which are the last 2 times when we have this combination of factors, we resolved to the upside in 2016 by the buy signals and the positive momentum and the rally above the 40-week moving average. We've gotten the buy signal. We're having positive momentum. And I think the last thing is the price getting above the 40-week, which gets us back to that first chart. Can we get above the 200-day or the 40-week and stay there? I think that's one of the most important questions that the market needs to answer. Here we're in the midst of earnings season. We're going to the first Fed meeting of 2023. A lot of potential catalysts to move the price. The question is, do we get above that 200-day moving average? This was a recap of some of the key factors to keep in mind with the 200-day moving average in the S&P 500. If you like this sort of video, please give it a like. We'd very much appreciate that back. Put a comment below. Do you think the S&P gets above the 200-day moving average and follows through or not? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well, be safe. Talk to you again soon.